And now today's featured speakers are Rich Cawthorn, 99, and Mark Salamone, 02. Rich, CEO of the Alpha Pension Group, started in the retirement plan industry in 1999 and has since been working towards improving the quality of retirement plans and employee education. Additionally, Rich is an investment advisor representative, a certified retirement plan specialist, and recently completed his coursework for the accredited investment fiduciary designation from the University of Pittsburgh. Rich speaks quarterly at public conferences and investment committee meetings about the retirement plan industry's best practices and prudent management of retirement plan investment offerings. Mark is CFO and principal at Alpha Pension Group and has been in the retirement plan industry since 2003. Since joining Alpha Pension Group in 2006, Mark has worked with companies and their employees, assisting with the implementation and coordination of their defined contribution retirement plans. Mark has a passion for working with plan fiduciaries to measure the success of the retirement plan and for developing action plans to pursue retirement plan objectives. Without further ado, please join me in virtually welcoming Rich and Mark. Thank you both.
Thank you, Emily. We appreciate your introduction and for having us. Truly, Mark and I are flattered to be here. We loved our time at Bentley, and we're so happy to be here today. So we have a lot to get to. We're going to talk about the CARES Act and the CARES Act in the context of retirement plans. So before we get started, we'll tell you a little bit more about Alpha Pension Group, and then we're going to get right into the CARES Act, which really did do a lot of things, but it impacted retirement plans in so many ways. So whether you're a business owner offering a retirement plan or simply someone participating in a retirement plan, this does impact you. So we're going to talk about what that means in the sense of RMDs, if you are retired and taking an RMD or thinking about taking an RMD, limits on deductions, loans, and so many other features. There's some technical aspects as well in terms of the process of getting at your money if you want a loan or distribution. And if you offer a retirement plan as a business owner, there's certainly things you need to know in terms of navigating the nuances of the CARES Act. There's many other considerations which we'll touch upon as well. And then at the end, we'll tell you how Alpha Pension Group can help you either individually or as a company and business owner. So we'll get right into Alpha Pension Group. So as Emily mentioned, I started Alpha Pension Group right after I graduated Bentley in 99, a few years working for a larger company. But then in 2003, I started Alpha Pension Group. I wish there was a brilliant story here, but I honestly talk a lot, and I wore a suit to work one day. So they put me in the sales department at that big company, and I didn't want to travel any longer. So I started Alpha, and the point of Alpha Pension Group really is to help businesses offer competitive retirement plans to their employees. And not just setting things up on day one, but setting a plan up to help make sure employees always have a quality retirement plan. And also making sure the plan isn't too complicated so you can run your business and focus on being profitable. I did it alone for a couple of years, but Mark joined me in 2006. We're still trying to figure out whether that was brilliant or crazy, because my offer to Mark was, I have a really good idea, but I can't pay you. And I probably can't pay you for a couple of years. So Mark joined me in 2006. We put our resources together, and in 2008, doubled the company. We now employ 24 people. Proudly, many of them are Bentley alumni. Certainly, all of the interns we have working for us, and we usually have about 4 a year, are all from Bentley. We have 600 corporations, companies, small businesses, large companies as clients. And when you aggregate the employees, it's about 52,000 people that work for the companies that we support. When you aggregate the assets, that's about $3 billion. So we're very proud to be part of Bentley's curriculum here, and proud to be alumni as well. So let's get right into the curriculum. We're going to talk about the CARES Act. I'm going to pass it off to Mark to define exactly what the CARES Act is, and then we'll get into the nuances of how it impacts retirement plans.
Thanks, Rich. Yes, the CARES Act was the federal government's response to the coronavirus pandemic and the impact it was having on the economy, with not only just individuals losing their jobs, but companies, industries completely shuttering. So the Coronavirus Aid, Relief, and Economic Security Act has a lot of impact on the economy in various ways, through small business lending, through delay of student payments on debt, for student debt that they've accrued over the years. But in addition to that, there's an impact on 401k plans, specifically corporate retirement plans. And it really affects retirement plans in three ways. Required minimum distributions for 2020 are going to be handled differently than in years past. Coronavirus-related distributions. This is a whole new distribution option that participants in retirement plans can access if they've been affected by the coronavirus. And last but not least, coronavirus-related loans. So we're going to walk through what each of these three items, how they previously were handled, and now post the CARES Act, how 401k plans are adjusting. So Rich, why don't we walk through what required minimum distributions have been set up for years and how they're handled?
Sure. So up until last year, the age that you had to take money out of a qualified retirement plan, most commonly a 401k plan, was 70 and a half. At the end of last year, a little legislation was passed, which is now seems like a million years ago, called the Secures Act, which moved it from 70 and a half to age 72. So you would have to take your money out of the plan. Essentially, the government wants to tax it before you die. At age 72. But the CARES Act changed that.
That's right. So for the CARES Act and for 2020, actually the RMD is not required. So for 2020, you're not required to take a required minimum distribution. It can be taken if you want, just like any other withdrawal. If you're in retirement and you're looking to take money out of your retirement plan, you can. If you've already taken your RMD, you do have eligibility to roll it over. However, it has to be within 60 days of actually taking the distribution. So that covers RMDs. As far as the new distribution option, most retirement plans, when you are an active participant, you really have limited options on ways that you can get access to the money. This will allow participants that have been affected by coronavirus to get access to their money. But before we get into that, why don't we walk through what traditionally 401k plans have been set up to allow their participants to do as far as distribution options go.
So if you are a participant in a retirement plan, an employee with a 401k, you had a couple of options before the CARES Act, as Mark mentioned, and they essentially were loans, which we're going to get to in a moment, or hardships. So not every 401k offered hardship distributions. It was a specific feature that you could adopt. And what a hardship is, as it sounds like, is if you're having a financial hardship, which the IRS defines what these financial hardships are. I'll give you an example: medical bills or not being able to pay your mortgage. And you would have to take the bills or the eviction notice to your employer and say, I want to have access to my money. But it was very cumbersome. So the employer, if they offered hardships, would then need to certify that the eviction notice is legitimate, and then you would get your money. But when you got your money, in addition to paying current income taxes, you also would have to pay a 10% penalty, or what we call excise tax. And the genesis here, the whole point is, they really didn't want you to have access to your own money. And if you did, they were really discouraging it with that 10% excise tax. So the CARES Act changed this in a very big way, and they're allowing for distributions. Now, they're not hardships, but Mark will talk about what the new rules are.
That's right. So this would not be considered a hardship distribution, but a coronavirus-related distribution. So for those that are impacted by coronavirus, and we're going to define what that means on the next slide, for 2020, you're actually allowed to take $100,000 or 100% of your portfolio, whichever is less, out of your account. And that 10% penalty Rich mentioned for typical distributions, if you're under age 59 and a half, is actually waived. But what does it mean to be impacted by coronavirus? Well, if you or a spouse are sick with coronavirus, you fit the definition. If you've been laid off, furloughed, if you don't work the same hours, if you've been unable to work because you don't have childcare. I know a lot of us are working from home right now with kids running around. That will fit the definition of a person that's been affected by coronavirus. The good news is with these withdrawals, unlike typical withdrawals, you do not have to pay all the taxes in 1 year. You can actually spread it evenly over 3 years. So starting in 2020, you can take a third for 2020, 21, 22, and actually pay the taxes over that period of time. Or if you want, and you can do this, you could pay back the distribution back into the retirement plan. If you're able to do that, you could potentially take the money out, put it back in, and avoid taxation altogether. Now, this money is not eligible for rollover. So if you take it out of the retirement plan and you want to put it into your IRA, unfortunately, you can't do that. As far as if you're a plan sponsor or an employer that's offering a retirement plan right now, you can do this, but you have to make plan amendments to your retirement plan before 2022, which I think is actually great. Typically with legislation with retirement plans, that legislation comes along and you normally have to amend the plan prior to people being able to do this. So in this case, this is getting the money faster into people's hands if they need it, and an amendment's not holding anything up.
So Mark, a couple of things here before we move on to loans. One, prior to the CARES Act, and I think this is very important, the whole perspective is we want to make sure people don't touch their retirement because we want it to be there for when they retire. But the spirit of the legislation was we want to make it accessible and easily accessible. So not only can you get your money and they're going to waive the 10% penalty, but they're giving you the option to put it back in. In other words, if you have some short-term expenses or some emergencies that come up because of the COVID crisis, they're making it easy. And that's why they defined, as Mark pointed out, the definition of whether you're impacted by COVID or not to be very broad. So we get a lot of questions about a few things here. One, are they really going to, meaning the IRS, come back and check and audit us and to see if we really did have a spouse, or are we going to have to keep records to prove that we were affected by COVID? And the general understanding is no. Again, the spirit of the legislation is to be very liberal and to allow people to have access to their money if they need it. But there's a couple of technical things here that are very important. Mark mentioned you can put your money back in if you want, or you can spread the taxes over 3 years. So I know this Thursday, Bloom Shapiro is talking about the CARES Act, and that's probably the best recommendation, the best way to answer that question. Keep good records and really have a good CPA, because putting that money back in or spreading those taxes over 3 years, not only is it cumbersome, but if you think about it, you're going to have to refile your taxes after the fact if you're putting money in. So we generally get a lot of questions about that. I would check out the Bloom Shapiro, I believe it's this Thursday webinar, but certainly keep your records because you're going to need them. So you won't be audited necessarily on were you affected by the COVID, but the IRS may come back to say, did you pay the appropriate amount of taxes on those distributions?
That's right, Rich. And the IRS is continuing to clarify how this CARES Act is going to work when people do take distributions. So that webinar will be helpful. So increased loan limits. Rich, you want to talk through what typically 401k plans have set up for loans?
Sure. So if your plan allowed loans, and not all 401k plans have to or did offer loans, before the CARES Act, essentially you could get 50% of your balance, up to $50,000. So to illustrate that, if you had $1 million in your 401k balance, the most you could get is $50,000. Or another way to look at that is if you had a balance of, let's say, $20,000, the most you could get is $10,000. So again, that was designed to make sure that if you needed money, you could get at it. But really the point is to keep it in there for down the road when you actually do retire. The CARES Act changed this one in a very big way.
That's right. And those loans usually are at most modeled out for 5 years. You'd have to pay the loan back typically within a 5-year span or less. And with this CARES Act, there is going to be an increase on the value of the loan that you could take. So if you're someone, again, that's affected by coronavirus, and we walked through the definition of that, and we'll revisit that again on the next slide. If you're considered affected by the coronavirus, you could take the lesser of 100% of your plan up to $100,000 out as a loan. And additionally, you won't have to start making payments for 12 months. So if you take a loan today, and right now you're not getting a paycheck, well, that's good news because you won't have to continue to make a loan payment right now when you probably can't afford to do that. Additionally, if you have a 401k loan already outstanding, you could also delay making that payment for 12 months, again, if you're affected by the coronavirus. And so here I think is a helpful example of what that looks like. So if someone were today considered affected, again, if you're sick with coronavirus, if a spouse is sick with coronavirus, or if your hours have been reduced, you could be potentially qualifying for this. And if you need to take a loan, you can, and you can delay making a loan payment up to 1 year. During that period of time, the interest is accruing. Now, 401k loans, when you're paying the interest back, you're paying that interest back to your own account. So when you start making payments, those payments will be a little higher because all along that interest is accrued, and that might be a little higher payment than you're used to. But the good news is that interest is going right back into your account. At the end of that 12-month suspension period, the loan is going to be reamortized. And if you had an existing loan on the books already, we're going to push that loan maturity date out 12 months. Again, here's the fine print on what it means to be able to take this type of loan. Again, the loan, you'd have to qualify using that coronavirus-related definition of someone that's been affected. This applies to loans made after March 27th through September 23rd. And again, the requirements are the same as the withdrawals that we talked about before. Now, if your plan right now only allows for one loan and you have one loan outstanding, you will not be able to get this loan. You'd have to pay that loan off first before you'd be able to take the coronavirus-related loan. Now, the loans are potentially an option for participants, but we think there's a lot to consider. And Rich, you started to talk about this a little earlier, where the CARES Act is expanding liquidity for a lot of people, but there's pros and cons to this. Do you want to walk through this slide and what this means here?
Sure, thanks. So, you know, if you ask us prior to the CARES Act whether we liked loans or hardships as an option, it would be a trick question. We would say neither, right? We're retirement nerds, and we think you should keep your money in the plan for as long as you can. But prior to the CARES Act, if you said, no, you know, what is better? If we need to take money out of our 401k plan, we probably would have said loans, because you are, as Mark indicated, paying yourself back interest, and it has an opportunity to go back into the plan, whereas a distribution, you know, it never goes back in. However, now that the CARES Act is expanding the distribution option under the coronavirus distribution and waiving that 10%, that actually may be a better option. And the reason being, if you look at this chart, you know, as attractive as taking out potentially $100,000 from your 401k may immediately sound, paying that back can be quite expensive. So as this chart indicates, it could be $1,800, you know, every month to put back in, and that's quite a big payment. So our overall strategy, and again, everybody's different, right, is under the distribution option. Remember, you have access to $100,000, and you can put it back in. But that doesn't mean you need to take $100,000 all at once. So if you are in a situation where you need to take some out, think about taking out immediately what you need before taking out the entire amount. And certainly if you need to take a loan, it's a great option. But the cautionary tale here is, you know, if you do take out more than you can actually put back and have, for an example, an $1,800 payment every month, that loan could default, which would again be immediately taxable in the year that it defaults. So I guess the point here is just tread lightly. A lot of liquidity options, but be careful before you actually take the distribution or the loan.
Rich, while you were talking, reviewing this slide, I was checking the Q&A, and I found a couple questions that are pertaining to this, so I figured we talk about them. So as far as withdrawals goes, are you allowed to do multiple withdrawals as long as you stay under the $100,000 limit?
Yes. So you can take multiple withdrawals, and that's probably the most prudent thing to do. And most of the, we'll get to this, most of the record keepers, the custodians, the one that hold the actual company assets, are waiving the distribution fees for this. In other words, prior to the CARES Act, it might be every time you take money out, you need to pay $30 or $50 depending on the vendor. But many of them have waived them. Before you take the distribution, check to make sure they are waived. If they're not, I would recommend getting in touch with either us or your fiduciary consultant, because they can get them waived on your behalf. Mark has transitioned us to this slide, which is a great transition because we're talking about record keepers or vendors. So you recognize some of the names here: Empower, Fidelity, Paycheck. So again, these are the ones that hold your company assets. So if you're a participant, you get a quarterly statement from one of these companies. And if you are a business owner, potentially you will have one of these companies as your selected vendor. Each vendor, and there's about 50 different options you have adopted these provisions and taken different philosophies on the CARES Act entirely. So the slide we're looking at, starting with ADP, Fidelity, TIA, many names you recognize, they did what we call automatic adoption. So Fidelity, for example, they're the biggest. They took all of their clients and said, unless you raise your hand, you are now adopting the CARES Act. So you have the $100,000 loan provision, you have the Corona distribution option up to $100,000. And that is both good and bad. In other words, some companies that we work with didn't want this, didn't know they had it, and had companies taking distributions or loans, or rather employees taking distributions or loans. So be careful about the company you're with. Make sure you know the options you have and whether your company has opted you in or opted you out. And I know, Mark, you're going to talk about the companies that make you raise your hand to actually opt in.
That's right. So on this slide, if your company's 401k plan is with any of these providers listed, and this is not a complete list of all that require some action, but these are the, typically the ones that have a lot of clients and companies as 401k providers. These are the ones that where, unless your employer has opted in and proactively either done some paperwork or communicated with the record keeper, the CARES Act is not in place. Now, most of these record keepers have done a very good job of communicating with all of their clients to make sure that if they want to opt in, they have all the resources available to do that. But again, if your company's 401k plan is with any of these providers here, you would have to do one extra step to get this CARES Act enforced. And again, the good news is just simply by alerting the record keepers that you want to be a part of the CARES Act and have those options available for your employees. And if you're in those plans, as a participant, you'd have that ability to take the money out. The good news is there is no plan amendment required, so nothing would hold that up other than some paperwork or some sort of communication.
And at Alpha Pension Group, Mark and I, our team, we work with all those vendors, and that's just a sample of the different vendors. And I can tell you that whether you're opt-in or you're opt-out, that's just the beginning. There's actually a lot more that goes into that, and a bunch of different logistics in terms of how does someone take their money out? More importantly, how do they put it back in? So, in sort of the design of a plan, you usually have the record keeper, the Fidelity, let's call it. Then one leg of the stool is also, the company. Make sure that last leg of the stool, which is either a broker or a consultant or a financial advisor, understands the nuances of that. If you're an employee and not an owner of a company, make sure that you have someone that you can talk to about what your options are. Many times, there are companies that have advisors that aren't fully engaged. And as a participant, what we always say is, vote with your feet. If you don't think you're getting the service from that advisor, make sure you let your business owner, human resources department know so you can get the resources that you need. And the reason why I mention that is, there's a lot of considerations that go into offering the CARES Act. In the context of employee education, which is something that we focus on a lot at Alpha Pension Group, what's important is, can employees afford to retire? A lot of other employees are thinking about saving up resources, they're getting their accounts before they can retire. Others don't want to lose their benefits when they do retire. So along sort of the life cycle of working for a company, you need to have really quality investments with low fees, but you also need to have this education component. We call it a wellness campaign to make sure that you're getting good guidance, because if you have the CARES Act as an option, what you need to know is, well, what does that mean to you individually? Should you take all or part of a distribution? Should you take a loan or a Corona distribution? These are all individualized conversations. Make sure that you have that resource that you can have that conversation with to get the guidance so you make proper decisions. Unfortunately, with retirement planning, it's really hard to undo bad decisions.
And there's a lot of other options out there, Rich, right? So the stimulus checks that were part of the CARES Act and that were delivered, or hopefully are still being delivered, because I know people have, not had their accounts set up with the IRS, might not have got their checks yet, but stimulus checks, delayed tax payments, enhanced unemployment benefits. I mean, there's a lot of ways that participants right now who are in a tough spot have an ability to, potentially, fill in the income gap that they might be experiencing right now, not having regular employment. So that the 401k is that type of thing that if you need to access it, you have to. But if you can delay it or potentially avoid it altogether, for your long-term future, it's probably the best option.
Going back one, or?
There you go.
Yeah. So we've done this a few times, Mark, but I haven't memorized them yet. I'll get next time I'll have it memorized. But so you know, again, with the CARES Act, you know, there's an opportunity to enhance your retirement plan at work. And again, whether you are a business owner or someone working for a company, you know, you have the ability to have other options here. And I think that comes with a lot of responsibility. So again, whether you're making the decision for the company or just part of that decision, voting with your feet, going to your business owner, your boss, your human resources department and say, do we have this CARES Act or do we want this? You need to make sure that you realize the full context. And whenever any decision is made for a retirement plan, and I guess this first comment's talking to the ones that own or are responsible for the retirement plan at the workplace, make sure you document your decisions. Just because Fidelity, as an example, opted you into the CARES Act, you need to have meeting minutes talking about why that's a good thing for your company, what you're going to do to communicate that, and are you going to adjust that decision down the road? For an example, if no one's making or taking any advantage of any of the distributions or loans, should you remove those provisions? We have a lot of companies talking about potentially, you know, stopping or temporarily stopping anyhow their company match. You need to document those decisions. They can really come back to haunt you if your plan was ever audited. And it's just good best practice to have a good process anyhow. In the context of an employee, make sure you have a resource to ask these questions. I've already talked about this, but before you talk about should you take a loan or a distribution, or I know one of the questions we got, you know, should we convert, and we'll answer this in a moment, to a Roth IRA, or should I change my asset allocation? You know, what about, you know, are you managing your debt appropriately? Are you budgeting appropriately? Do you have the right amount of savings? You know, the big question that people don't think they can answer, but actually you can, is how much do you need in retirement? So make sure you have that resource for you available at work. Most likely there's an advisor tied to your plan, which is a very unsophisticated way of saying you're paying for a service already. You should make sure that that you have that available to you. So you know, that's just a cautionary tale, and Alpha Pension Group would be more than happy to be a resource for you and your company at any time. So here's our contact information. Our phone number, that's my email address. Mark is just Mark at Alpha Pension Group. You know, what we have found, we've done a bunch of these webinars on the CARES Act and many others for clients and for non-clients. What we found is ending early and giving people a piece of their afternoon back is a great way to make friends. I know there's a bunch of questions which we'll get to, but that is the primary part of what we're talking about. When the coronavirus pandemic started to roll out, Mark and I looked at each other and said, you know, listen, you know, we got to take care of our families and our employees, but after that, like, what can we do for the community? And what I mean by that is the retirement community. Because we're not saving lives here at Alpha Pension Group. I think there's a moral good to what we do. We enjoy doing it. We work with some great companies, but we're not saving lives. So the only thing we thought that we could do is, whether you are a client or not a client, and this goes to participants that are on this webinar or anybody else, companies, it doesn't matter, individuals, we've given away our education curriculum complimentary for the foreseeable future. So in May, we have webinars on Thursdays at 3 p.m. Mark and I have little kids at home, as Mark mentioned, so we thought it'd be cool to give our significant others a break and with homeschooling. So there's now a Fun with Finance for the kids on Wednesdays. And we have many other webinars for companies to join. Please follow me on Twitter or our LinkedIn page at Alpha Pension Group or Mark or I on LinkedIn for all of these updates, because there's an incredible amount of content that we're just giving away that we normally save for our clients, but we're giving away complimentary for the foreseeable future. So Mark, I know there's a bunch of questions in there, or if anything else you want to add, feel free.
Well, typically we got a few other questions. You know, the beauty of announcing this webinar ahead of time is your classmates end up showing up to the webinar and then texting you questions during this. So I've got a few texts, some to distract me, others that were legitimate questions. But as far as the CARES Act goes, your employer may or may not. One question was, does every employer have to amend for this? And the answer is no. So you have to ask of course, your retirement plan provider, your employer, whether or not these options are available to you. That's number one. The two questions we see here in the Q&A from Neil and Paul. Yes, we're going to have that PowerPoint available for people to download. I know we're recording this as well. And Rich, I don't know if you want to take the question here about converting a traditional IRA to a Roth. I think a lot of times during things like this, it's something you want to check with your CPA on and how this might impact your whole financial plan. But let me know, what your thoughts are on that.
Yeah, I mean, it's hard because that is definitely an individualized question, but keeping it as high level as possible. If you ever are going to do a conversion, the best time to do that is when the market's down, right? So what you're not doing is you're not selling your shares, so you're maintaining your cost basis, if you will, but that value is lower, so the tax bite is less. And if you're in good investments and you're not selling them, you would be able to appreciate that in a more tax favorable environment. So I know in 2008, many people took that as an opportunity with a depressed value to make that conversion. But definitely, Mark, I agree. Speak with your financial advisor or tax accountant because that's definitely an individual situation, because having a big tax bite impacts so many other aspects of your financial picture.
Excellent. A couple other questions that came in are, can your employer adopt some but not all provisions of the CARES Act? The answer is yes. So you might have an employer that either does one or the other, the loan option or the withdrawal option. So it's always good to be, again, to check with your employer on whether or not you can do this and have that available to you. Is there an extension of the Form 5500 deadline? The answer is no. That Form 5500 deadline, again, the Form 5500 for employers that offer retirement plans, that's like the tax return for the 401k plan. Every year it's due on a specific date that has not changed. So that date still remains the same. It's typically July. And depending on if you have a calendar plan year, and you can always extend that. But however, the date has not changed for 2020. On that, it's a lot of the same questions we've already kind of discussed. So I'll turn it back to you, Rich.
Yeah, I just have two last things. One question that we get sometimes is, it made me think of it last time with that IRA conversation is, just because your value's down, now is actually a great time if you are a business owner to approach your record keeper, your Fidelity, the one that holds your assets, to get a reduction in the fees that you're actually paying, whether they be hard dollar fees or asset-based fees. It's an opportune time to try and negotiate those down. As we all know, the primary driver of an account balance is obviously the performance, but right behind that, 1B, right behind that is the fees that you pay. So, speak with your consultant that you have working on your plan. If you don't have one, let Mark or I know. We'd be more than happy, again, complimentary service to give you a benchmark report to help you negotiate your fees lower. And I know, Mark, there's a question here about, and you've answered this before, the coronavirus distributions and loans impact 401ks, but do they impact IRAs? I think you're muted, Mark.
I thought I was going to go through a whole webinar without that happening. No, the answer is yes. IRAs apply. It's the same type of thing for the IRA withdrawal. So if you do have an IRA and you take a withdrawal from it, same type of thing. If you are considered affected by coronavirus, you do have the ability to treat it just like a 401k withdrawal.
And same for RMDs and IRAs. And in closing here, Mark and I have been doing these CARES Act for a while, and now our industry has sort of aggregated some information, which I think is helpful, which is, many companies have adopted these CARES Act provisions. But interestingly, when you look at what's been going on in terms of activity, it's very, very low. There's actually not a lot of folks, and now I'm talking about employees or participants, taking distributions. There's not a lot of folks taking loans. So I think this is more peace of mind to say, I know it's there if I need it, but the actual data suggests that the distributions and loans are really minimal at this time. Now, if this extends and we're sort of homebound still and the economy is not back up and running, through the summer, obviously I think that those data points will change. But right now, at least from our vantage point, it's very promising that although these options are available, very few are taking advantage of them. And I don't mean to be, crass with that. In other words, if you need this resource, your own balance to pay bills, great. But just coming at it from the perspective of a financial or fiduciary consultant, we want as much to stay in the plans as possible, because really in many cases you'd just be delaying a problem, right? And having no assets at retirement or less assets at retirement and not giving yourself the benefit of compound interest really would be a missed opportunity and an opportunity cost. So if there's no other questions, Mark, I really enjoyed being here. We're flattered that Bentley asked us to come back. Here's our contact information. Please don't be shy. And thank you so much.